time value of money. The core concept of the time value of money is that $1 today is worth more than $1 tomorrow. This is primarily due to inflation, which erodes the purchasing power of money. For example, if you had $10 10 years ago, it might only buy you $8.20 worth of goods today, even with a low inflation rate of 1.5% to 2%. In other words, to have the same purchasing power as $10 10 years ago, you would need $11.80 today. Key financial formulas. There are two important formulas to remember. Present value, PV. This formula helps you determine how much money you need to invest today to reach a specific financial goal in the future. The formula is PV equals FV/1 plus I, N. FV equals future value. I equals interest rate. N equals number of periods compounded. Actuaries in the life insurance industry use this formula extensively. For instance, if a life insurance company knows the future value, the death benefit, e.g. $500,000, and the interest rate, they can calculate how much the client needs to pay today to ensure they have the full amount ready in 40 years. Example, to have $5,000 in 5 years with a 3% interest rate, you would need to invest $4,310.05 today. When calculating this manually, you must multiply the bracketed part of the formula 1 plus I by itself n times, not by n. For example, for 5 years at 3%, you would multiply 1.03 by itself 5 times. Future value, FV. This formula is often used by investors to determine how much a current investment will be worth in the future. The formula is a rearrangement of the present value formula. Example, if you invest $5,000 today at a 3% interest rate for 5 years, it will be worth $5,800 at the end of the term. Stocks. Stocks, also known as shares or equity, represent ownership in a company. By purchasing a stock, you participate in the company's growth and decline. You can find stocks in segregated funds such as equity, balanced, or growth funds. Factors affecting stock price. Macroeconomic conditions. The overall economic health of a region or country can impact stock prices. Microeconomic conditions. This refers to factors within a single company, such as a new product. Investor sentiment. If investors have a positive outlook on a company, its stock price is likely to rise. The opposite is also true. How to buy stocks. Stocks are sold through an investment dealer or a discount broker. An investment dealer offers advice, while a discount broker only executes trades. Investors pay a commission when they buy and sell stocks. Stocks can be held in registered or non-registered accounts. Returns and risks. Returns from stocks come in two forms. Capital gains or losses. This is the profit or loss from selling a stock. You are only taxed on 50% of capital gains, and capital losses can be used to offset gains. Dividends. Not all companies pay dividends, but shareholders may receive them. Preferred shareholders receive dividends before common shareholders. Risks include loss of capital, market and industry risk, and currency risk. There is a range of risk in stocks from the least risky. Blue chip stocks, from large, stable companies, to the highest risk penny stocks, typically under $5. Investor protection. The Canadian Investor Protection Fund, CIPF, provides protection if a brokerage firm goes bankrupt, not if the value of your stocks declines. Bonds. A bond represents a loan from an investor to a borrower, the issuer, such as a company or government. In exchange for the loan, the issuer promises to repay the principal with a fixed amount of interest over a set period. Bonds are also known as fixed income securities or debt. Bond types and terms. Corporate bonds, issued by companies. Government bonds, issued by governments, such as the Government of Canada, GOC, which is the largest issuer of bonds. Bonds have a maturity date when the principal and any remaining interest are repaid. Terms typically range from 1 to 30 years and are classified as short-term, 3 years or less, medium-term, 3 to 10 years, or long-term, 10 years or more. Long-term bonds generally offer higher interest rates. The interest on a bond, known as the coupon rate, is typically paid twice a year and is taxed as interest income. The interest rate is based on the issuer's credit quality. A company with more financial problems will have a higher interest rate to compensate for the increased risk. Bonds are rated from safest, AAA, to riskiest, junk bonds. Advantages and disadvantages of bonds. Advantages. A wide variety of terms, issuers, and credit ratings are available. The repayment of the principal is guaranteed. Disadvantages. A significant lack of transparency. The sale price can result in capital gains or losses. Guaranteed investment certificates, GICs. GICs are considered one of the safest investments because they guarantee the return of your initial investment, or principal, plus a set interest rate at the end of a specific term. Like bonds, a GIC is a loan from an investor to an issuer, such as a bank or insurance company. GIC terms can be up to 10 years, though people typically invest for 2 to 5 years. Types of GICs. Fixed interest, the most popular type for Canadians with a known fixed interest rate. Cash flow redeemable, allows access to your money, but with a lower interest rate. Escalating, the interest rate increases over time. Market linked, the return fluctuates based on the stock market. Benefits of GICs. Guaranteed return, your principal and interest are guaranteed. Low minimum investment, investments can start at just $500. No fees, GICs generally have no fees. Simplicity, they are simple to understand, making them great for new investors. Bypassing probate and creditor protection. If purchased through an insurance advisor with a named beneficiary, GICs can bypass probate fees and offer creditor protection. Risks and disadvantages. Inflation risk. Inflation can erode the purchasing power of your GIC's fixed return. Interest rate risk. If market interest rates rise, your GIC's fixed rate will not increase. Low returns. The guaranteed safety of GICs comes with lower returns compared to other investments. Early withdrawal penalties. There are penalties for withdrawing money before the end of the term. Exchange-traded funds, ETFs. ETFs are investments that mimic or follow an underlying index, industry, or commodity. They are professionally managed and trade on a stock exchange, offering daily transparency on their fluctuations. Fees and returns. ETFs are generally more cost-effective than mutual funds due to a lower management expense ratio, MER. However, they have a trading expense ratio, TER, which is a fee for each transaction, buying and selling. The more active the ETF, the higher the TER. ETF distributions can include interest, dividends, capital gains, or cash. Advantages and disadvantages. Advantages. Diversification. ETFs allow you to create a customized and diverse portfolio for your clients. Transparency. They are transparent because they trade on the stock exchange. Lower costs. ETFs have a lower MER and no sales loads, front-end, back-end, or DSC fees. Disadvantages. Complexity. ETFs can be very complex, making advisor advice important. Liquidity risk. ETFs require a buyer to sell, so you might not be able to sell when you want to, making them better for long-term investments. Investor protection. ETFs are protected by the CIPF for up to $1 million in the event of a dealer failure. Group plans. Group plans are sponsored by an organization, typically an employer, to attract and retain employees. Management of these plans can vary, from professional management to employees managing their own investments. The most common types are defined benefit and defined contribution pension plans. Advantages and disadvantages. Advantages for employees. Simple enrollment. The process is easy to get started with. Forced savings. The plans encourage saving for retirement. Employer contribution. Employers almost always contribute to the plan, and it's often a mandatory contribution. Group purchasing power. This can lead to more investment choices that an employee might not have access to on their own. Fees paid by employer. The employer, as the plan administrator, pays the fees. Disadvantages for employers. Liability. The employer is responsible for any deficit if the plan's guarantees are not met. This is why defined benefit pension plans are becoming less popular. Payroll management. For some plans, the employer must manage payroll deductions, which can be extra work. Investment risks. Understanding the different types of investment risks is crucial for making recommendations to clients. Inflation risk. The risk that inflation will reduce the purchasing power of your money over time. This risk most affects fixed income securities like cash, bonds, GICs, and annuities, because the returns don't increase with inflation. Interest rate risk. The risk that rising interest rates in the market will make your fixed rate investment less valuable. With bonds, as interest rates go up, bond prices go down, and vice versa. Market risk. A systemic risk affecting a large portion of the market, such as a market decline due to an economic recession, natural disaster, or terrorist attack. This primarily affects stocks and bonds. Loss of capital. The risk of not being able to retrieve your initial investment. This is a major risk with annuities, as once you hand over a lump sum, you cannot access those funds. With a straight life annuity with no guarantees, payments stop upon the death of the annuitant, and the remaining capital is kept by the insurance company. Credit risk, default risk, the risk that an issuer, company, or country will fail to repay its loan, bond, at maturity. Rating agencies like Moody's assess this risk, rating bonds from AAA to C, junk bonds. Foreign exchange risk, currency risk, the risk that the value of an investment in a foreign currency will decrease when converted back to your local currency. For example, a Canadian investing in a US dollar-denominated fund is at risk of losing money on the conversion. Liquidity risk. The risk that you cannot convert your asset into cash quickly when needed. An investment is considered liquid if it can be converted to cash in under 30 days. Real estate and annuities are examples of illiquid investments because they require a buyer or the funds are locked in. Industry risk. The risk that an entire industry is negatively affected by consumer indifference or labor unrest, strikes. An example of consumer indifference is the decline of Sears, while labor strikes can lead to a company's financial ruin as expenses continue to accumulate without any production.